Welcome, I'm Mark Todd from the NAB, and today I'm joined by Adam Watson. He's the CFO of Transurban to talk about some of the initiatives that Transurban have entered into in Canada, to talk a little bit about their debt profile and a little bit more about how he sees the opportunities in the markets at the moment. Adam, welcome. How are you?
I'm very well. How are you?
Thanks for taking. I'm good. Great time. I mean, it's a beautiful part of the weather in Melbourne. It's fantastic at the moment, so it's great to come down and talk to you. Let's talk about Transurban. You've done a little bit of work of late. You're in Canada. You bought the A25. Walk us through the strategy around the A25 and what opportunities you see there.
Yeah, thank you. And Canada has been a market that we've been looking at for quite a while now. And in our business, we need to be opportunistic at times in terms of when assets are available. Then we're obviously then keen to get involved insofar that it fits our strategy. And our strategy as an organisation is about operating in markets that are urbanised with population growth, the densely populated cities. And Montreal is certainly one of those where you've got this very large city that's growing, got very strong employment, and the growth happening more towards the northern end of Montreal, which is where the A25 is located. It's a 7-kilometre odd toll road operation in Montreal. And we were very successful, obviously, or very excited, I should say, and therefore successful in acquiring that asset a couple of months ago. Just awaiting now final regulatory approvals over the next coming period.
Is that a tender process? And the price you paid, I think, was about, $1.2 billion? Is that the way the process works? It's a tender process to be the best winner?
It was. It was sold by a fund who was at the closed end of the fund. So a fund had a finite life, and they were therefore required to sell that as part of winding up their fund. The asset itself has been performing very well, so it's been a very stable asset over time. It was a competitive bid, and again, we were very happy with the price that we paid. From our perspective, at 1.2 billion, that includes the debt, so it was about $840 million worth of equity, and then we assumed some debt. The price we paid in terms of multiple was a little less than what we paid on equivalent transactions here in Australia with AirportLink and Transurban Queensland. So from a pricing perspective, very happy with the outcome.
So when there's criticisms from some of our content partners around the fact that they think, Intelligent Investor said they thought you paid through the nose, how do you respond to that when you've just made the statement it's similar to the prices you paid here? How does that work?
Well, again, we don't focus on what an Intelligent Investor says. I guess we focus on making sure that it's going to be accretive to our investors, which it is from day one. It becomes cash flow accretive. It's a mature asset that's performed very well in its life to date. It's got inflation-linked pricing. It's a strong concession, and we also think that there's a number of development opportunities that we can undertake over time in Montreal to build out that network in that city, the way that we've done that in the other cities that we operate in and around Australia and North America.
Okay, so you have, the assets are mainly in North America and Australia, and now you've gone to Canada. Is there any risk around FX? Is there anything about jurisdiction? How do you see comparable like for like? Are you putting some challenges to the business to understand the different jurisdictions?
Yeah, and obviously the cultural elements and our relationship with our government clients is really important, and we've done a lot of due diligence in that space, and we're very comfortable with the relationship that we believe that we can have with those government clients in Canada, as we've done throughout our other markets as well. It's obviously, again, an asset that we think will fit nicely in terms of our portfolio, in terms of geographically being comfortably manageable. And from a FX risk perspective, any of the debt that we would raise there would be local debt, so we wouldn't take any currency risk there. So again, very comfortable with the way that we can fund that project and the cash flows that it will provide us.
Let's talk about debt, because a lot of people are concerned about debt. I think you've got $25 billion in debt, and I think in general, a lot of people who might look at this video are not necessarily familiar with the idea of how debt works in different companies. So how are you viewing debt in a world where we are expecting higher rates going forward over the next few years?
Yeah, the market cap is about 25 billion. Our debt book is about 14 billion, is our proportional debt book. And we've worked really hard for many years now at providing a lot of mitigating factors, or building into our debt books mitigating factors in the event that there is a rising interest rate environment. We've done that by having a long dated debt book now, so our average debt book is around nine years, which really takes a lot of that refinancing risk off the table.
Fixed rate return?
It's all fixed, so well, certainly not, about 98% of our debt book is fixed, so we really don't have an interest rate exposure for our existing debt, and from a currency perspective, 100% of our debt is brought back to the local currency where it resides, so again, we don't take any currency risk. I think what I'd also add is that it's really important to understand that we also have these fixed, in addition to these fixed hedges that we have in place, we've got some natural hedges in place insofar that certainly our Australian assets are inflation linked. So we have CPI pricing escalators built into the concession deed. So when you have an assumption of rising interest rates, you also have offsetting that in our business, you've got rising inflation, and that obviously enables us to increase our prices. So that provides us with a nice natural hedge as well.
I think a lot of people don't recognise that. I think that's in the REIT market. I think that's in a lot of markets where you see inflation being priced into it. And I think for investors, it's hard to understand, okay, what's the inflation kicker and how do I think about it? When you talk to that point, how does that play out in your mind around the dividend strategy? How does that, I think a lot of people who are investors in Transurban think about the dividend policy. What can you point to that?
Yeah, it's a really important point, because obviously we try to always balance what we have and continue to want to deliver, and that is a healthy distribution and consistently growing distribution as well. And it's been growing very nicely over the last few years, and we would like that to continue to grow. And a lot of that comes back to the stability of our earnings. You've got traffic and CPI-linked inflation pricing. Our revenue line item grows steadily each year, and we're very comfortable with the business characteristics there. Our job also is to ensure that we don't have any volatility when it comes to our costs and interest, and our debt costs are really the biggest costs that we have in the organisation. So those hedges that we put in place, as I mentioned before, by having a long-dated debt book, as I mentioned before, are really key to be able to provide us with stable earnings, stable cash flows, and therefore provide consistently growing distributions to our shareholders.
Thanks for taking the time to talk. It's been fascinating. I've really enjoyed it. All the very best with all the investors. That is Adam Watson, who is the CFO of Transurban. Now, if you're interested in Transurban, please take the time to do the due diligence, or if you are unfamiliar with enough of the information, go to an advisor, get the advice. This is not a recommendation of Transurban, but it's been an enjoyable conversation, and I hope you enjoyed the video. Thank you.